This is the Precious Metals Briefing with Jerry Williams. Safeguard your money.
Welcome to another edition of the Precious Metals Briefing. I'm Tony Famino, here again with Jerry Williams, the founder and vice president of American Precious Metals in Arizona. Now, the vaccines show us that there could be an end to this pandemic that we're all in, but today you will discover why precious metals investing is more important than ever in this post-pandemic economy. And today we are joined by Jim Rickards, the author of a brand new book, The New Great Depression, Winners and Losers in a Post-Pandemic World. And for many of our listeners, Jerry, and they're very familiar with Jim, for instance, with The New Case for Gold, a previous book that he's had. He writes a lot about precious metals and specifically gold. So I'm going to turn this over to you, Jerry, and to Jim, and take it away.
Thank you, Tony, and thank you and good morning, Jim. I can't tell you how appreciative I am of you taking time out of a busy schedule with a new book coming out now, which I have read quite a bit of, by the way, and I highly recommend it. You must have had a staff of statisticians in big numbers to come up with all the statistics, but I'd just like to jump in with the very first question on everybody's mind, I think, is you mentioned the new Great Depression like a prediction, but are we already in it? And how would you define the difference between a recession and a depression?
Well, it's a great question, Jerry. The answer is yes, we are in a depression, and there is a difference between that and a recession. So let me start with recession because it's a little easier. A recession is defined as 2 consecutive quarters of declining GDP. There are a couple other factors and bells and whistles there, but basically, when you have 2 quarters in a row or more of declining GDP, that's a recession. And there's actually a group called the National Bureau of Economic Research up in Cambridge. It's a private group, but they're, economists and, faculty members at Harvard, MIT, former government officials, et cetera. And they put their heads together and they decide when a recession starts and when a recession ends. So it's like an umpire calling balls and strikes. So we don't have to guess about it. They tell us, and they're recognized as the official arbiters. And they said that a recession started in February 2020, and I agree with that. I reached the same conclusion in my book, but that was their official declaration. They have not said it's over. That's not unusual. Sometimes a year will go by and they go, well, it was over last year. It was over 6 months ago, because they take a long time to make up their minds. But it's pretty clear from the evidence we do have that the recession was probably over around the end of June, July 2020. And I based that on the fact that in the third quarter of 2020, we had spectacular growth. It was up, economy was up about 33% on an annualized basis. That was after a tremendous collapse in the second quarter. So there's your recession. And I'll come back to that because they're probably in a second recession right now, what they call a back-to-back recession. A depression is different. A depression, economists first of all don't like the word depression. They've sort of banished it from the vocabulary. We have not banished it from history or the economy. They still exist, but economists just don't like to talk about them. And the reason is you can't quantify it. Now, a lot of people say, well, gee, if a recession is 2 quarters of declining GDP, and a depression is worse, that must mean 10 quarters of declining GDP or something like that. But no, that's not the definition. A depression is more than just a long recession. It can be, but it really means depressed growth. You can have growth in a depression. It's just that the growth is below trend. It's below what it used to be. And a classic example is very recent was the expansion from 2009 to 2019. Now, that was a 10-year expansion, the longest in U.S. history, but the economy only grew at an average annual rate of 2.2%. Now, historically, we had done 3.2%. That's the average of all expansion since 1980. If you go back to World War II, in an expansion, the economy usually grew over 4%. So 2.2% is growth, but it's depressed growth relative to the trend, relative to what we're capable of. So that's what a depression is. Now, you can have recessions in a depression. I would say that's exactly what has happened. If you say the depression started in last February, well, we had a recession right off the bat. Then we had growth in the third quarter and looks like the fourth quarter. But it looks like we're in another recession right now because of the spread of COVID and new lockdowns. So this could go on. The effects of this could go on for years. The behavioral effects will go on for 30 years. Now, I can explain why, but so yes, we are in a depression. We've had one technical recession already and probably heading into another one.
Well, Jim, what is your biggest concern personally in all of this?
Well, my concern is that a lot of this is not well explained to investors and everyday individuals and citizens and investors in particular. You get a lot of happy talk from Washington, and it doesn't. I don't really get into politics too much. Some people are Republicans, some people are Democrats. That's fine. One of the things I say in the book is that the virus is not a Republican or a Democrat. It just wants to kill you, and that's what you have to understand about the virus. Leave your politics at the door. Let's focus on the science. Let's focus on the economic science also, and not get too spun up. And again, we all have our views, and I respect that, but that's not really what I'm writing about. So what I point out in the book, The New Great Depression, this is in chapter 4, is that monetary stimulus does not work, and fiscal stimulus, basically deficit spending, does not work. Now, you can do it, and they are doing it. The Federal Reserve at the beginning of this new depression, so let's say last February, at the time, their balance sheet was about $3.7 trillion. Today, it's about $7.5 trillion. In other words, they printed $4 trillion of new money in less than a year. That's just between last February and today. And everyone says, oh, well, look at all that money printing. We're going to get inflation. And by the way, inflation, I'm not saying inflation is a good thing, but it does at least produce nominal growth, may or may not produce real growth, but it does produce nominal growth. But we're not getting the inflation. We don't have inflation. The Fed has failed to meet its inflation targets for 13 years. They started doing this in 2008. They can't even get to 2%. I mean, how are you going to get to 4% or something like that you really need to reduce the burden of the debt? So can you print money? Yes. But does it create stimulus? No. And the reason is something called velocity. Now, not to get too technical, but velocity is the turnover of money. So I'll give you a very simple example. Let's say I go out for dinner and I tip the waitress. And the waitress takes a taxi home and she tips the driver. And the driver goes to get gas in his car and he buys some gasoline. Well, in that example, my dollar has a velocity of 3. It supported $3 of goods and services, the waitress tip, the taxi tip, and the gasoline. So that's velocity of 3. But what if I stay home and don't do anything, watch TV, and don't spend any money? Well, now my money has velocity of 0 because I didn't spend any. There was no economic activity generated from it. Well, I always say, integral calculus is fine, but a lot of these big economic problems you can solve with fifth-grade math. So what is nominal GDP? How do you calculate GDP? Well, one way to do it is money supply times velocity times the turnover equals GDP. It's just a very simple identity. Well, if you take $7 trillion times 0, that equals 0. In other words, it's not the money supply that causes the inflation, it's the velocity. If you don't have velocity, you don't have an economy. And that's really the problem. The Fed can take their balance sheet to $10 trillion. They probably will, as a matter of fact. But that by itself does not cause any economic activity. If you don't lend it and you don't spend it, then you're not going to get the economic growth, or you're not going to get the stimulus. And right now, we're not lending and spending. The banks are taking all the money from the Fed and they're giving it back to the Fed as excess reserves, and people are not spending the money; they're saving the money. So that doesn't work. Now over to fiscal policy, deficit spending. Everyone's like, well, the Keynesian multiplier. If you borrow $1 and spend $1, you can get $1.25 of growth. That's the so-called Keynesian multiplier because the money turns over more, et cetera. Well, that can be true. There are all kinds of problems with it, but that can be true up to a certain level of what's called debt to GDP. What's the debt to GDP ratio? In other words, take the national debt, which today is around $25 trillion, divided by GDP, which is about $22 trillion, and that number is your debt to GDP ratio. Well, the research is very good that once that number gets north of 90%, that Keynesian multiplier I talked about goes below 1. In other words, now instead of borrowing $1, spending $1, and getting $1.25 of growth, now you borrow $1, spend $1, and you get 90 cents of growth or 80 cents of growth. In other words, you don't even get your dollar back. And that's where we are now. The debt to GDP ratio, I said 90% was the threshold, and there's research to back this up, and it's all in the endnotes of the book, so people can look at the original sources. But where are we now? Well, the answer is 135%. We say, well, who else is in that league? Well, the answer is Greece, Italy, and Lebanon. So there's your club, there's your dinner table that the United States is in with like some of the biggest debtor countries in the world. So can we have deficit spending? Yes. Can we have money printing? Yes. But the point I make is that it doesn't work.
Well, maybe a lot of that money is going into Bitcoin or someplace, some other financial asset. But which does lead me, you touched on something there, that we have a new administration coming in, and apparently they'll have Congress as well. Their whole philosophy has been modern monetary theory, and that could go on steroids. What do you think will happen now with the new administration?
Well, firstly, you make a very good point, Jerry. We are heading for modern monetary theory. I think we're there already. Whether people have heard of it or understand it, that's an interesting issue. But it doesn't matter. That's what they're doing. The big brain in modern monetary theory is a lady named Stephanie Kelton. She's a professor at the State University of New York, Stony Brook campus. I know Stephanie, very nice person. Met her. Very, very nice person, but I completely disagree with all of her ideas. But she's the kind of genius behind modern monetary theory. But she's not just an academic. She was chief economist of the Senate Budget Committee when Bernie Sanders was the chairman some years ago. She was the number one economic advisor to the Bernie Sanders campaign. And she's going to be a big voice in the Biden administration. And she says, hey, debt to GDP ratio is 135%. So what? Japan is 250%. So let's be Japan. Let's have $10 trillion, $15 trillion. Let's just spend all the money we want on whatever we want, finance it with government bonds, and if the market won't buy the bonds, the Fed can buy them, stick them on the balance sheet, hold them to maturity, and get their money back. What's the problem? Well, all that's true, by the way. The Fed can print that much money. The Treasury can borrow that much money. The Fed can monetize the debt. So there really are no constraints, no legal financial constraints on doing what I just described. And so when I first tackled modern monetary theory, it was a challenge because I'm like, well, I know it's wrong, but why is it wrong? What am I missing? Because it has a certain superficial appeal. The answer is there may be no legal limit on how big the Fed's balance sheet can get, but there is a psychological limit. At some point, people say, you know what, I don't have a PhD in economics, but I just don't like what I see. Get me out of the dollar. Get me into, hard assets, land, residential real estate, fine arts, silver, gold, natural resources, water, anything, but just get me out of the dollar. We saw that in the late 1970s. That was the last time it happened to quite that extent. A lot of people don't know or don't remember that in the 1970s, when Jimmy Carter was president, the United States Treasury borrowed money. They issued bonds denominated in Swiss francs. Nobody wanted the dollar. So they said, okay, we'll buy your bonds, but you have to pay us in Swiss francs because we don't want the dollar. And they were called Carter bonds. Now, they didn't last very long. Paul Volcker fixed that at the cost of a recession. But my point being, when people don't want the dollar, you can't force them to stay in it. And Professor Kelton thinks that you can't. She's like, well, you got to pay your taxes, and so we only take dollars in payment of taxes, and if you don't pay us, we'll put you in jail. So you're going to need those dollars. Well, yeah, to an extent, but people move out of the country. They move offshore. They, if I own gold or silver, or which I do, or stocks or anything else, if I don't sell it, I don't owe any taxes. You don't owe taxes until you actually sell it. So people just stop selling. They hold on to it, but they, et cetera. So there are a lot of legitimate ways to avoid taxes. And at the same time, if I've got to allocate assets, I can get out of stocks. The Biden administration is talking about drastically increasing corporate income tax. Leave aside the individual income tax. They're talking about raising corporate income taxes, but people can buy, as I mentioned, land, art, natural resources, silver, gold, other hard assets, and just sit on them. And what you're really doing is you're getting out of the dollar and into something else. So that can happen, and then that could cause a collapse of confidence in the dollar. So the theory is that you can print as much as you want, spend as much as you want. The Fed can monetize it, and it's not a problem. And my answer is yes, that's true up to a point, but then you break confidence, you destroy confidence, and people run to other assets, and one of them would be gold.
Good point. I'm sure our listeners are glad to hear that. I wanted to ask if this is a correct assumption. Since this is global and worldwide, we have an example out there in Japan, for example, has pretty much been in a depression since 1980, and that's
right.
What they're doing. You mentioned their spending. Is that the kind of template that we're looking at if we go that way?
Yes, we're heading that way. I don't think we'll get that far, and I can explain why. First of all, you're right. I remember in the 1990s, people looking at Japanese growth, they were actually in a recession. I would call it a depression. But they call it the lost decade. The 90s were the lost decade. Well, guess what? They're starting their fourth lost decade. The Nikkei stock index was 40,000 on New Year's Eve, 1989. It crashed to like about 7,000. It was down, over 75%. Never made it back. It's still not back. I mean, it's might be up around 20,000 or something, but it's nowhere near the 40,000 that we saw at the time. Actually, I look at my screen here. It's 27,000. There you go. But it's still way below 40. And the point being, it's 30 years later, 31 years later, and they never made it back. That's a depression. Now, Japan has had some growth, but they've also had a series of recessions. Remember, I said you can have recessions inside a depression. The depression has more to do with the fact that you never grow your way out of it, and growth is below trend, and that's exactly what's happened in Japan. So they have financed a lot of it with debt. I mean, they're investors and banks and pension funds in Japan that complain that there's nothing left to buy because the Bank of Japan bought everything. I mean, you think the Treasury's bad, you think the Fed's bad buying Treasury notes. The Bank of Japan buys stocks, bonds, corporate bonds, junk bonds, you name it. They've got it on their balance sheet. But there are a couple of differences. Number one, in a way, Japan is free riding on the dollar. When I say free riding, the dollar is the global reserve currency. The dollar has to have a certain amount of stability behind it in theory. So the Japanese don't have to worry, because as long as the dollar is propping up the whole system, they can kind of do things that wouldn't work in the U.S., but they kind of work in Japan because they're depending on the U.S. to prop up the entire global system, number one. Number two, the Japanese are very homogeneous. They don't have the diversity of the United States, and they buy their own debt. Now, in the case of the United States, with our, I mentioned, $25 trillion of debt, that is the national debt approximately, a big chunk of that, not all of it, but a big chunk of it, about 17, 18%, is owned by China, Taiwan, Japan, and a few other countries around the world. So we're very dependent on foreign investors. Japan's not. Most of the Japanese debt is owned by the Japanese, so they kind of owe it to themselves. So they're in, and they haven't collapsed, but they haven't had any growth. How are you going to do 30 years of low growth in the United States? That doesn't work. The United States, the American citizens are not going to tolerate that. So I think Japan does have a much higher debt to GDP ratio, but I don't believe that's a good analog for the United States for the reasons I mentioned. One, they're free riding on the dollar. Two, they owe most of it to themselves. And they have another thing going on, which is they have a declining population. So when you look at Japanese numbers, not on an absolute basis, but on a per capita basis, those numbers are better than the aggregate numbers because the population's going down. I had a conversation with Sakakibara-san. He was the assistant Japanese finance minister in the 1980s. His nickname was Mr. Yen. So I met him in Korea. I said, Sakakibara-san, I said, what's going on in Japan? How are you going to get out of this? And he said, well, what you're missing is that the population is declining, so the per capita numbers are actually better than the other numbers. And I said, okay, so so you're going to end up in a place where you got one person left in the whole country, and she owns the whole thing, and is the richest woman in the world. And he kind of laughed, but it was meant to be humorous, but it shows you the absurdity. So what are we going to do in the United States? Like, make the population decline so that the per capita numbers look better? None of these things really work in the United States, and that's part of what modern monetary theorists are missing.
What do you think the Chinese are doing? Do you have any handle on how they're handling this post-pandemic?
I think they're making a lot of mistakes. Their numbers look better, but the numbers are whatever they want them to be. It's a completely controlled economy, and a lot of their GDP numbers are better, but it's driven by investment. Now, in the United States, 70% of our GDP is consumption, and investment's about 20% give or take, and then 5% is the rest, government spending and net exports. In China, it's different. China, the investment component is about 45% of GDP, but a lot of that investment is complete waste. I've been to China many times. I've been to these ghost cities. I got mud on my boots, going out looking at construction sites. And they build these ghost cities. And as I say, I've been to them. So they'll have a couple skyscrapers, apartment complex, a country club, a hotel, a golf course, a subway stop, a highway connection, some housing, retail space, etc. And it's all empty. I mean, empty. And I've been in nice looking buildings. The construction's fine, but they're okay. So they create 10,000 construction jobs. They buy steel, they buy concrete, they buy glass, they buy copper, they buy all the installations and fittings and everything else. But they don't get anything back. There's nobody's there. They're empty. And this idea that, well, we'll build it, like, it's Field of Dreams. We'll build it and they will come. I said, no, you don't understand. I said, there's huge obsolescence. The buildings survive because people are in them and they use them and they maintain them and they fix things. You can't just put a building in the middle of somewhere and think it's going to be, you can just close the doors and open it up in 10 years. No, the glass is going to fall out. There'd be weeds growing up the side of it. And I've seen this in Africa after the commodities boom in the 70s. So in the short run, yes, it gets you real GDP, but in the long run, if you're using decent accounting methods, you would write it off because it's going to waste. But they're financing it with debt. So China looks like a massive debt bubble. They can keep it going for a while. I'm not saying it's going to collapse tomorrow. And they've also got Chairman Xi has shown himself to be probably a worse dictator than Mao Zedong. He's not the kind of consensus builder. Some of these guys are really bland, but they kept their heads down and kept things moving. Xi's not like that. They have their diplomatic corps. They call them wolf warriors, wolf warrior diplomats. So China all of a sudden has decided they're going to take on the United States, confront us head on, be aggressive, engage in a lot of propaganda, a lot of fraud, etc. So I view the place as very, very unstable. All that bluster really hides the fact that it's not very stable on the inside. So hard to be very bullish on China.
For somebody who's just listening, it's say in the middle class, 2 incomes, no kids, or 2 incomes and 3 kids. But the average person looks at all this and feels helpless, and maybe they're getting government unemployment or something like that. What any particular advice for younger people or people in the middle of all this?
Yeah, that's an important question, Jerry, and I do have that advice. It's funny. I had this conversation with my editor before I started writing the book. First thing she said to me was, Jim, you're great on the economy. We're glad you're doing this, and someone needs to write a book on this new depression. But keep away from the medicine because you're not a doctor, and I'm not an epidemiologist. I said, hold on. I said, that's like asking someone to write about property damage in New Orleans in 2005 and not mention Hurricane Katrina. So I have to talk about the pandemic because otherwise the economic discussion makes no sense. So they agreed, and I did my homework, and I read over 100 peer-reviewed papers, and I balanced it out. It's funny. I thought it would be when I started. I thought it would be straightforward in the sense that there'd be a bunch of nutty conspiracy theories and all that over here, and there would be a bunch of science over there, and all I would have to do is stick to the science and study it and write about it. Turned out that I did discard the fringe theories. That was easy, but when I got to the science, I found that the scientists disagreed with each other. I could show you peer-reviewed papers by PhDs that one guy says, you need a mask. You're a fool to go outside without a mask. Masks are the key to stopping the spread. And another scientist will say, no, the virus is much smaller than the weave in the mask. People don't wear them correctly. They're not designed correctly, and they don't do any good. So all of a sudden you've got scientists disagreeing with each other. By the way, if anyone ever uses the expression, the science is settled, they're trying to shut down the debate, and they say the science is settled, they know nothing about science because science is never settled. There's always a debate going on. So we got through that, but then my editor said, okay, well, if you're going to write about the pandemic and the depression, you got to get something positive for investors to do. And I said, absolutely. I'm not going to write a long book about all these problems and not give people concrete suggestions. So chapter 6 describes my methodology. I don't just make assertions without backing it up. So describes how I do the analytics and the predictive analytics, but that has very specific recommendations for investors. And then the conclusion, which comes at the end, describes the only way to solve the debt crisis. The Fed has lost sight of it. No one in Washington understands it, but I understand it, and a few others do, and I describe it. And two U.S. presidents in the 20th century did this successfully. One was FDR, and the other one was Richard Nixon. So I describe this for the readers. So the point is, yeah, there's a lot of bad news out there, but no sense sticking our head in the sand. We need to understand it, but there are definitely things you can do. And one example I give, Jerry, is I think most of your listeners will know about the Weimar Germany hyperinflation of the early 1920s. That story's been told quite often. But what people don't know, there was a guy in Weimar Germany in 1921. His name was Hugo Stinnes. And what he did, he saw this coming. And he went out and borrowed a massive amount of money in Reichsmarks. He bought hard assets. In his case, he bought steel, coal, vessels, railroads, transportation, etc. The hyperinflation came. He paid off the debt. I would say pennies on the dollar, but a millionth of a penny on the dollar. Basically, the debt was worthless. He could pay it off with worthless money because it had devalued that much. But he kept the assets. He had all the hard assets and became the richest man in Germany. His nickname was Inflationskönig, which is German for the inflation king. So I use that example as to say, look, even in the worst hyperinflation in history, just about, you can still get rich if you see it coming and you know what to do. And I give other examples of that. So, yeah, as bad as things are, there are definitely asset allocations. There are assets that make sense. There are others that do not. Timing is important. You need to be nimble. But I explain this all in a lot of detail in Chapter 6 of the New Great Depression.
You mentioned the second possible wave. Do you think we are in the second phase of the first virus, or are we already in the first phase of the second? Because there's another one coming,
Yeah, probably both. And so to some extent, this was called a second wave of the original virus. Although even the original virus broke into two strains or variants. There was one of them went from Wuhan, China, and hit the west coast of the United States. It hit Seattle and California. Those are the earliest reports we have. This goes all the way back to last January, January 2020. But then it went west from Wuhan via Beijing or Shanghai to Milan, Italy. And that's why Italy got whacked. And that's really what caused the stock market to collapse. The stock market was watching China, but okay, it's in China. It's not coming here. They got it under control, which wasn't true, by the way, but that was the thought. But when it turned up in Italy and they saw the exponential growth, they said, okay, this is it. It's escaped from China. It's spreading around the world. It's coming our way. And that's actually when the stock market started to go down February 24th. But so that's called the Italian strain because it was a mutation. And that's the one that hit New York and the East Coast of the United States. And it's why, initially everyone was saying, Andrew Cuomo did everything wrong and Gavin Newsom in California did everything right. Well, I would say they both did everything wrong, but the fatality rate in New York was far higher because they were hit with a different strain. That was the Italian strain. Now, come forward to today, so that Italian strain is still going around, and that's what caused the death toll to go up in Texas and California and Florida and a few other places. But now we've been hit with a new strain, which was originally identified both in South Africa and the southern part of England. So, call it the English strain if you want, but that's here now. It's in the United States. And here's the hard. So we're getting hit with both at once. The fatality rate, the number of fatalities and cases today is higher than it was last March. I mean, go back to last March and April, you would have thought the world was coming to an end. Well, it's worse right now. So this wave is bigger, but the new strain is here also. It's spreading very fast. It's more contagious than the original one. Now the other question is, first of all, do the vaccines even work against the first strain? They say they do, but these tests were rushed, and I don't blame people for that. I mean, yeah, you had to get the vaccine out there, but this is still experimental as far as I'm concerned. You go get the vaccine, that's fine, but you're kind of a guinea pig because they don't really know exactly how it works. But that aside, does the vaccine, even if the vaccine's effective, work against the new strain? We don't really know. It's too early. So this it's good that the vaccines are out there, but this pandemic is far from over.
Well, I'm trying to figure out the best takeaway for some of these customers that are asking me should I buy some platinum? It's half the price of gold, or do I buy silver because it's so cheap? It's half of what it was 9 years ago. Got any feeling on those kinds of questions?
Yeah, well, the thing with silver, platinum, and palladium, they're technically precious metals, but they have industrial applications. So when you analyze them, you have to ask yourself how much is a flight to quality and hard assets, but how much is involved with industrial applications. So you could be going up on flight to quality and hard assets, but going down because the economy is going to go back into recession. Gold is different. I spent a lot more time looking about gold. I definitely recommend gold. The thing about gold, it's not good for anything. It's the best form of money. Gold is the best form of money. It works in inflation. People understand that. Gold also does extremely well in deflation. That's very counterintuitive, but during the Great Depression, which was the longest period of sustained deflation in U.S. history, gold went up 75% from $20 an ounce to $35 an ounce. So it works in kind of every state of the world. It's the best form of money, but the industrial applications are almost done. There's some specialized applications, wires, ultra-thin wires and coatings of space helmets and things like that, but not much. And people go, what about jewelry? Jewelry is just wearable wealth. So if you have bangles or bracelets or necklaces or whatever, that's fine. But it's just gold bullion that you can wear around your neck. That's how Indian brides think about it, and that's the right way to think about it. So gold's easier to analyze because it's just money, and it's the best form of money. And the short answer is it's going up a lot. I mean, my intermediate price target is between $10,000 and $15,000 an ounce by maybe 2025. But I always tell people, you got to get to 3,000 before you get to 10,000. So you're going to see a steady increase over the next 4 years. Very
encouraging. I guess we can discount the business channels and their predictions of a V-shaped recovery. That's of course sort of out of the question, isn't it?
Yeah, all that that pent-up demand. And there's no pent-up demand. I mean, this is Larry Kudlow, and Larry's a good guy, by the way, very decent individual, but he's got the worst forecasting record of anyone other than the Fed. And you go back to last spring, April, May timeframe, they were talking the economy will come roaring back in the summer because of pent-up demand. Well, like my wife and I, we were, March, April, May last year, we were quarantined and locked down just like everybody else. And usually we go out to dinner on Friday night, but we didn't because we were locked down. Well, by June, things started to open up a little bit and we went out to dinner, but I didn't order 9 dinners. I mean, I had skipped 8 dinners, but I still only had one because I usually only eat one dinner at a time. In other words, the other 8 dinners that I skipped, that was permanently lost. It wasn't like I was going to make it up by ordering 8 entrees. So the point is, there's a lot of places that closed down. They said, oh, well, they'll reopen in July. No, they're bankrupt. They're closed. The leases are broken. The staff is laid off, permanently unemployed. The equipment's up for sale at fire sale prices, and the entrepreneurs have moved to, Tennessee or Florida. So a lot of these losses are permanent. They're not coming back quickly, if at all. And the people are struggling with unemployment. And now it's all getting worse again because we're going back into a new lockdown.
Well, Jim, I'm really impressed with all your information, and I am halfway into your book, and but I know there's going to be an ending, and I'm anxious to get to that. And I would highly recommend anybody listening to get their hands on your book, The New Great Depression. I think they'll just be amazed at how much information is in there. And you've got a very good track record for predictions, too, going back to long-term capital management in 98, and then, of course, the meltdown in the mortgages in 08 and 09. So I really appreciate all this information.
Thank you, Jerry. It's great to be on your show.
I close, I don't know if you ever heard of the Wizard of Iz, but I close with this comment. He who has the gold makes the rules.
You've been listening to the Precious Metals Briefing with Jerry Williams. To learn more about safeguarding your money, go to apmaz.com or call 800-522-GOLD.